With AT&T's Warner Media and Discovery set to merge, the combined entity expected to shake up the media landscape. But for AT&T, this isn't just about a renewed focus on 5G, but also a way to reduce debt. This week's Yahoo U taking a look at how the structure of the deal allows for a tax-free transfer. Brian Cheung here with a lesson on reverse Morris Trust. Brian.
Well, class is in session, and in M&A land, usually it's the big fish eats the little fish, right? But in the wild west of M&A, there are all different types of creative ways to go about deal making, and one of them, as you mentioned, is a reverse Morris Trust. And the big attractive benefit of a reverse Morris Trust is having a tax-free transaction on the sale. Now, let's look at the AT&T deal one more time to understand how all of this went down. So we know that the idea, right, is to create a big media company. So Warner Media is owned by AT&T. It's got HBO, CNN, other channels. Discovery, on the other hand, is its own publicly traded company. They've got HGTV, Food Network, etc. Now, some people are going to look at this structure and say, all right, well, it's AT&T trying to get rid of Warner Media, and it's Discovery that's buying, right? Not so fast. So the reverse Morris Trust deal, step one is the big kahuna, which is AT&T in this case, spinning off the division that it wants to sell. So pretty easy stuff, right? They want to graft out the Warner Media subsidiary. Now, step two here in the reverse Morris Trust deal is merging that subsidiary with the outside company that wants to join the fold. In this case, that's Discovery. And the new company is going to become its own publicly traded entity. We don't know the name yet, with its own shares. Now, none of this so far is probably going to be all that crazy, right? But the question naturally is, who is going to own this new company? Who's going to own shares of whatever they end up naming this? And this is where the reverse Morris Trust comes in. So under the terms of the AT&T deal, AT&T shareholders, who will, by the way, still hold shares of AT&T stock, they're also going to get stock in the new company, whatever it's called, representing 71% of that new company. That's per the press release that we got earlier this week. Now, on the other side of things, Discovery shareholders who would have their shares just converted into shares of whatever the new company is going to be would only be holding 29% of the new company. And this is really critical. So in a reverse Morris Trust deal, shareholders of the company that's selling the assets have to hold more than 50% ownership of the new combined company, a majority. If this figure were to be less than 50%, that would not make this a reverse Morris Trust deal. It would fail that test, and therefore it would be possibly a taxable transaction, which is exactly what AT&T is hoping to avoid with this transaction. Now, the question naturally, of course, is, all right, so if it's not so binary where it's one company buying the other, what does AT&T get out of this? Well, per the release earlier this week, AT&T is going to get about $43 billion in cash and debt securities. Now, interestingly, this is going to be a big part of the strategy for AT&T because people who have been following this company know that this is a company that is heavily indebted. So by having some of the certain debt pushed down to the Warner Media subsidiary and absorbed by this new publicly traded entity that's outside of AT&T, this might be one way to handle all of that debt. Now, what's been interesting is that the reverse Morris Trust deals have not been so common over the last few years. In fact, the most memorable one was back in 2017. That was Lockheed Martin, a defense contractor. And this type of thing is not so common because you can kind of see the mechanics of all of this, right? Discovery is actually the smaller company in this case trying to merge with another company, but they can't be so small where they can't pull this off. But they also can't be big enough to try to get over that 50% threshold where it would no longer be a reverse Morris Trust. So very interesting stuff here. Underscores how there's many different types of flavors of M&A, which is definitely worth watching for anyone trying to see if there might be further media consolidation in that space. But guys, that wraps up at least this week's Yahoo U. Class is dismissed.
And Brian, in a rare pairing between Yahoo U and our takes at the end of the show, we put out a poll asking what exactly you would cancel. If you had to pick one streaming site, which one would you cancel? We're going to have the results of that poll later in the show, but I'm going to put you on the spot. Disney Plus, HBO Max, Hulu.
I think I get rid of Hulu. Yeah, I watched the OC.
There you go.
And then after like the third season, I was like, I don't need this anymore. So that's it.
Yeah, I think Zach and I may be in agreement on that one. But you'll have to stay tuned.
I don't like the shots fired at the OC here, though, Brian. I'm gonna take issue with that because
It was bad after season 3, dude. It was bad after season 3. You know. I mean,
this is a contentious debate. Surprisingly, right? Which
Get
one
this
you
man off the air is all I'm saying. Take Professor Brian Cheung off the air after that comment.
All right.
All right, Brian, you're dismissed for the day. You are dismissed for the day. And a reminder, we're going to have a result of that poll later on in the noon hour, so you'll want to stay tuned for that.